Thank you, Mr. Chairman, and Chairman Bernanke, thank you so much for your time all the way over here. Last one today, and apparently next time will be the very, very last one as well. So a number of the questions that I have been answered, and we certainly have several, but we'll try to make this somewhat brief. On the rulemaking and supervision, one important component is identifying the supposedly systematically significant non-bank institutions for enhanced federal regulation. Can you update us on that process, and can you help give me some assurances that this designation process won't be overly broad or arbitrary? For example, talk to many insurance companies that are in the property and casualty business, life insurance companies that feel that they're going to get lumped into this process because AIG obviously was involved in this. But we know that their property and casualty business was really not a problem in this instance. It was really more the derivative side. So can you comment on that for me?
Yes. It's the responsibility of the Financial Stability Oversight Council to set rules and make these designations. We have put out for public comment a proposed rulemaking that would ask for input about what criteria should be used. We're looking forward to getting those comments and to establishing a set of general criteria that we will then apply. And then we hope, I think, to have begin to make designations by mid-year. I think would be a goal. So the process is moving forward. There are different views about how broad this should be, and I think the agencies on the council will need to continue to discuss it. The Federal Reserve has indicated that we think that a relative handful of firms will be so designated. We don't want to overextend this definition. That being said, we want to be sure to include every firm that would be a serious threat to systemic stability in the case of its failure. So I don't know the exact answer because, again, there may be some different views around the table, but we should have some more clarity by next few months.
Are we going to wait until, because I know that the FSOC's expert hasn't even been named or appointed yet. Are we going to wait until after that's appointed?
That's a good question. It certainly would be desirable to have the insurance industry represented. We have a state insurance commissioner now, but we need I think another position as well, but you're correct.
Thank you. Another question that I had is that with regard to the methodology, what methodology did the Federal Reserve use to determine that $600 billion was the correct amount of money to deploy for the open market Treasury purchases?
We have been able, through various studies, by looking at the impact of purchases on markets, to derive a rough equivalence between purchases and points on the federal funds rate. And our very rough equivalent is that something like $150 to $200 billion of purchases is roughly the same as a 25 basis point cut in the federal funds rate. So $600 billion was interpreted by us as roughly a 75 basis point cut, which would be a significant cut, but not an unprecedented cut, one that would be taken in a situation where a significant additional stimulus was needed. And we seem to be seeing the kind of response that we would get with a 75 basis point cut. So that was roughly the analogy. And of course, we used our forecasting models and the like to try to assess what that impact would be.
What would you consider, Mr. Chairman, standards for determining success or failure of open market purchases, and should you need to go into them again?
Well, the first question is efficacy. Is it doing what we expect it to be doing? And I think in a preliminary way, it looks like it is. It seems to be having the effects on markets that one would anticipate. Beyond that, I think there are two criteria corresponding to the two sides of our mandate. On the first side, we'd like to see the recovery on a self-sustaining pace. When stimulus is withdrawn, we'd like to see the private sector leading a sustainable recovery. On the inflation side, I think we have succeeded in moving the economy away from deflation. We just want to be absolutely sure that we don't allow inflation to go above the levels consistent with our mandate in the long run, which is, in our view, about 2%.
Thank you, Mr. Chairman. I'd like to yield what little time I have remaining to my colleague from Wisconsin, Mr. Duffy.
I think the